Hello friends and welcome to another risk reward matrix video at Arctic Money channel. This one is risk reward matrix for the winter season 2024. And right now on your screen you can see my latest or the previous risk reward matrix that I did in May 2024, so April-May this year. This is how the situation looked back then. Obviously some companies I might have updated my valuation, and obviously all companies move around this matrix basically as their stock price moves. So if the price goes hugely up, the reward becomes smaller unless there is changes in the valuation naturally. So that is how my risk reward matrix works. Reward being the expected return, how undervalued or overvalued I perceive the company to be. Risk, in this case, I don't mean the risk definition you can find in the business books in business schools. Risk for me is not volatility. Risk for me is risk of permanent loss of capital in combination with my own confidence, how well I think I understand the company and what is the level of my understanding of the company. So there are two factors that go into my risk profile here. So this was how the situation was back in April, May this year earlier. And now we move on to my updated risk reward matrix for November, which you can see on your screen right now. So have a look at the previous one if you want to see how these things change. But without further ado, let's begin with the pink box you can see there in the upper left hand corner. This is my executive summary of my situation now. 3 points made famous by the Finnish president. You always, when you present, you have 3 points. So I'm following the teachings of Alexander Stubb how to do this presentation. So 3 points by the Finnish president. Number 1, luxury and fashion seems cheap. What I have been following, and especially the luxury and fashion companies I follow, Kering, not Flow Traders, but Dr. Martens, Kering, Burberry, even Crocs. What else we have here? LVMH. All of these have gone down in stock price during this year a lot, which has meant to me that their valuations has gone better. And I have also been just following what other people have been saying about other luxury and fashion companies. Of course, there might be value traps in there. Not all of them are good buys, obviously. But what I have been following as a mega trend is that luxury and fashion seems to be getting cheap. Number 1. Number 2 point, US tech and S&P 500 seems really expensive to me. I have been saying this for a long time. I guess I did own some, for example, Google, if I don't remember completely incorrectly, in 2022, last time, when you can say that when looking for example, price and earnings, forward price and earnings numbers, you could say that the US stock market didn't look too overly expensive in 2022. But after that, I think I have been pretty constantly saying in my videos that US tech, the big names everybody knows, and at the top of S&P 500 as a whole, because of them, to me it seems really overvalued. Nothing more I can say, and this becomes evident when you see the left bottom corner of this risk reward matrix. We go there soon. And point number 3, lots of lower risk, okay return alternatives emerging now, in my opinion. Lower right corner, the best corner in this risk reward matrix you can be. You would hope all the companies to be where you want to invest, in the bottom right corner. Obviously it's rare that a low risk company trades at an attractive valuation, obviously. So that is why you see lots of empty space there. But as said, the names such as Greggs, Amsterdam Commodities, LVMH, Canadian Pacific, Kansas City, the railway, together with Origin Enterprises, Alta Beauty, even Kering and BML. Maybe Kering is a little bit more riskier even, but BML, Alta Beauty, Origin, Greggs, Amsterdam Commodities, LVMH, Kansas Pacific, sorry, Canadian Pacific, Kansas City, difficult name with that company. They all look okay value. They are not huge buys. You will not make huge money with any of them. I don't think, but they come with relatively lower risk in my opinion. So saying that there would be nothing in the market where you could invest in your money is completely false according to me. Here are my examples of businesses with pretty good moats trading at not an attractive value but okay value in my opinion. So those were the 3 points made famous by the president of my country, Alexander Stubb. Now we go to the individual companies. Let's begin from the right upper corner. There you can find high risk, high reward plays Alibaba and Kamux. Kamux is a used car sales company operating in main market Finland, but operating also in Germany and Sweden. And the thing with Kamux is that I don't think they have moat. I haven't identified any moat with Kamux, and that's the thing. What makes it such a high risk play, in my opinion, when you don't have a moat, then it becomes lots more difficult to invest in a company, obviously. But why I have been investing in Kamux, and it's not a small position in my portfolio, is that I believe there is the whole industry in Germany, Sweden, especially in Germany, but also in Finland and Sweden, is quite highly fragmented. There are lots of players in the used car industry, and there is lots of room for consolidation, in my opinion, and that kind of is the biggest reason why I find Kamux interesting. If they can come on top of that consolidation phase of the industry, it would mean good things for the company. The valuation is really attractive. That's why it's so high up in my reward. But there is also a risk when you operate in an industry where it's hard to find a moat. It becomes trickier, if you know what I mean. Then Alibaba. We all know China risk. I have been talking about it lots of my channel. Alibaba went a little bit higher 1 month ago, came back down lower. The company is buying back their own share because the management of the company feels too that Alibaba is trading too cheaply, as it has been trading too cheaply for many years now. Still a big part of my portfolio. China risk is the risk. That's why it's high up in the risk. Otherwise than that, if Alibaba would be a company from any other country in the Western world, it would be trading with a much higher valuation. That's what I can tell you. So that is why I'm invested. Should things get better in the world, China doesn't do anything stupid, Alibaba will do fine, for sure. The company is great and the valuation is too low for it. Then inside the circle, I've made this circle for you to point out that maybe best buys in the market, in my opinion, you can find inside that circle. There we have Flow Traders, Burberry, Dr. Martens, and Uranium. I think these companies present the best opportunity in the market right now. They are not small risk plays. For example, Flow Traders I've labeled pretty high because it is fintech industry, which is not really inside my circle of competence. So I have had a need to read a lot about the company and the industry to understand it to a sufficient level to have the courage to invest my money in it. But Flow Traders is a hedge against volatility in the market, and I think the markets have been sailing pretty calmly through the recent times, and I wouldn't be surprised if there is periods of increased volatility ahead, and that in that kind of environment, Flow Traders should make good money. Attractive valuation with all of these companies, obviously, that I labeled this high here. Then Uranium, well, lots of videos on Uranium on my channel, so if you want to know why I'm invested in Uranium, go check those videos. The spot price is still pretty low in my opinion. Uranium still presents pretty good opportunity. I think so. Then we have Dr. Martens and Burberry. One Burberry luxury company, Dr. Martens, let's say high fashion boots manufacturer known for their iconic boots. I think these are the types of luxury and fashion companies I've been talking about. I think their stock prices have been hit way too low. They present I think they present opportunities where you can double your money in 5 years or so, even faster if tides change. Iconic brands, in my opinion, both have brand moats, but the trick is that fashion industry, luxury industry is unpredictable. Fashion trends are unpredictable. Retail is difficult business always. So that's where the risk comes. Nevertheless, I feel the valuation is pretty excellent for both, and that's why I'm invested in both, and they are so high in my matrix. I have actually bought back into Crocs, this time though with much higher stock price than last time. First time Crocs entered my portfolio, it was at 60 euro, 50 euro levels. Now it's at 100, but what can you do when you do another valuation? And it seems like Crocs don't go away. They just keep on growing in the world and people keep on buying them. I felt that the valuation at the time was so attractive that I actually opened up already a small position again in Crocs. Everybody knows those are ugly sandals. I have an old Crocs videos, couple of them actually in my channel, so go watch how I made money with Crocs last time. I believe we are entering to a similar situation again. And then Kering, that's another luxury fashion company. Again, same story as with Berber and Dr. Martens. And actually, let's already talk about LVMH. I have positions in all of these companies in my portfolio right now. LVMH valuation is not super low. Kering is a little bit better one, in my opinion, although it comes with bigger risk because Kering is such a smaller company than the huge one, maybe the biggest company from Europe, LVMH, Louis Vuitton, Moet Hennessy. So they do have a different kind of risk profile. Nevertheless, I feel they are all good buys at these levels. Then BML, that's biomedical laboratories from Japan, doing exactly what the name would suggest. So testing industry in Japan quite or shares the same characteristics as Eurofins. My prior position, I owned stock of Eurofins, but I sold everything after Muddy Waters research report. That's why you don't see Eurofins anymore in this matrix since the last video. I'm not following it intensively anymore. If you want to know about that story, go and watch that Muddy Waters short report video on Eurofins on my channel. Then we have Ulta Beauty, beauty retailer in the United States. Warren Buffett owns it. I own it too. Presents very okay risk level, very okay valuation in my opinion at the moment. Origin Enterprises, we talked that in my last video, so interested in that, go and watch that video. Greggs, biggest fast food chain in the UK, has actually come a little bit down in stock price and is close to a very close. I have to keep an eye on that because I really would like to own Greggs. I do believe in their business model, and it has gone down price a little bit recently. So interesting situation with Greggs. Amsterdam Commodities, spices, tea, herbs. What do you have there? Trader in Europe, stable business, food business. I own it in my portfolio. No big changes there. Still presents okay valuation in my opinion. Nothing huge has happened with that recently. And then one company down in the risk, and I don't think you can find much more safer businesses than railroads in the United States. So Canadian Pacific Kansas City, difficult name. That company is really low in my risk profile, entering a good valuation already. Just like to see the stock price go a little bit down, and I want to become railroads owner like Warren Buffett himself too. Other companies close to fair value. Let's tackle those ones starting from the higher risk. CoreCivic. So I already in my last video on Origin Enterprises mentioned to you that this was the private present I still own in my portfolio. Their competitor GEO Group I sold, I can't remember, 1 year ago maybe. I made excellent money with GEO Group. The environment where we are now with higher interest rates, and they might even be higher for longer still. Nobody knows. GEO Group has much more debt than Core Civic, so that is why I perceive that to be more riskier position than Core Civic here in my matrix. GEO Group in valuation, Core Civic, and both. Okay, never mind the valuation. What happened with GEO Group and Core Civic? Let's go that over now. Trump trade is what they call companies that would benefit if Donald Trump got elected as President of the United States again, and he did, as we all know. GEO Group and Core Civic both went up in price during last week, something 80 to 100%. Obviously, I made huge profits with my Core Civic position. I have already sold out of it. I knew I wasn't playing any Trump trade. I don't do that kind of speculation. But as you know, who have been watching my channel for a longer time, I have been following these two private person operators for a long time. And I mentioned in my earlier videos that Republicans in power could be a catalyst for the stock prices. Never the thesis why I invested in them. The reason I invested in these companies was that they were trading so cheaply compared to what is on their balance sheet. They were trading under liquidation value when I bought them. So what do I mean with liquidation value? It means that if, for example, government comes in and pays the fair market price of all assets GEO Group and Core Civic own minus all their liabilities, the stock price was way lower than what I perceived the value of their real estate to be and other assets. And this is why I invested big time to both of these. And GEO Group, Core Civic private presence ended up being the best investments I have ever made in my life. Biggest profits I have ever done in money, in dollar amounts. So this is value investing. As Benjamin Graham says it, Mr. Market is manic depressive. He goes through periods of great depression, and when he's sad, you need to buy companies that are beaten down, and when he becomes optimistic and everything is unicorns and rainbows again, then you sell back to Mr. Market, and this is what I did with Core Civic and GEO Group. If I were a student of Benjamin Graham, I think Benjamin Graham would have been proud of me. That's a huge compliment to myself, but I think I deserve it. And that goes to what Warren Buffett says to the most famous student of Benjamin Graham, that you cannot expect to buy something that is really popular and expect that you will make huge money with it. That's not how investing works. You buy something that is out of favor, rather you buy something that is out of favor, that still has lots of value, but for some reason the stock market and other people are not appreciating it at the moment. You buy it, then you wait for something to change when they and Mr. Market become optimistic again. And this is exactly what happened with GEO Group and Core Civic in the Trump trade when Trump got re-elected. This is investing, this is value investing, and if this doesn't make sense to you, you need to read a little bit more about value investing, and that's how it is, unfortunately. Then, going forward, other companies I perceive to be in okay valuation. Those are Tyson Foods, meat producer in the United States, still have that in my portfolio. And let's tackle the big companies, the big tech of the United States, which I said is overvalued. Well, Alphabet, Google is close to fair value in my opinion. Might be that it's not overvalued. If I would need to invest in one big tech company today, that would be Alphabet. I think that's pretty much the only one in okay valuation out of all of those companies. You have there are also other companies with very low risk. I think out of the big tech, next after Alphabet in valuation terms, reward-wise, come Berkshire Hathaway and Microsoft. Microsoft is not terribly overvalued, but it is overvalued. Berkshire Hathaway is, again, not terribly overvalued. And I actually want to say one thing about Berkshire Hathaway. Warren Buffett has lots of cash at the moment, and that makes Berkshire Hathaway better investments because that man knows how to use the cash when the opportunity arises. So you might even want to switch in my risk-reward matrix, Berkshire Hathaway and Microsoft, vice versa actually, because a bet on Berkshire Hathaway is a bet on Warren Buffett, and that's pretty good bet to take many times. Nevertheless, Berkshire Hathaway still is overvalued. That's why I'm not owning it. Might be that Warren Buffett proves his genius again when the next crash comes someday, and Berkshire Hathaway makes great buys and great gains, but I feel it's still overvalued and I'm not owning it. Moving on to, obviously, these companies that you can find the lowest in my risk-reward matrix, these are the best companies of the world in my opinion. I would love to own them. They are the best companies of the world. Problem with them is the valuation mainly. At the moment, as I said, US Tech, S&P 500, overvalued. That goes to Apple and Meta. Both are pretty massively overvalued in my opinion, and I don't expect anyone to make huge money with them next 5 years, to be honest. Apple is a new one. I just did a valuation on that, and I remember doing that valuation. I didn't do a video for you on Apple because everybody knows what Apple does, so I didn't feel like a need for it. I was lazy, sorry. But Apple, I think my valuation ended up being like Apple could crash minus 50% tomorrow, and then I would be interested starting to buy it. So that's how overvalued I perceived it to be. Meta is probably roughly the same valuation. These two would need to, like General Dynamics and Lockheed Martin, to US defense sector companies. All of these four, Meta, Apple, Lockheed Martin, General Dynamics, would need to crash maybe 50% tomorrow for me to buy them. That's how overvalued I think they are. And they are great companies. They have great tailwinds. Everything is great. But you need to understand in investing that it's not enough when you have a great company. You cannot invest only in great companies. Investing in great companies is other side of the coin, and the other side of the coin is that what am I paying for this company? And in case of these four, General Dynamics, Lockheed Martin, Meta, Apple, the market is asking me to pay too much, not worth it. This is investing, this is value investing. I would love to own these companies, and hopefully someday I will, but at the moment their valuations are too high. Service Corporation, that's the biggest funeral home and cemetery operator in the United States, overvalued, even though the industry is pretty stable, as you can imagine, on what they do. Carriage Services there, that position, I actually sold a little bit early, I guess. I sold at $32 levels, and now it's trading already at $39 levels, but what can you do when my fair value was there, $32, $33? So I sold everything, and of course the stock can go even higher, but I don't care. That's not how value investing works. When the fair value is achieved and I think I have better opportunities in my portfolio, I need to sell, and that's what I did with Carriage Services. Overvalued at the moment. In the summer, you can see that Park Lawn Corporation has disappeared from the from my risk-reward matrix. It disappeared because the company in the stock market doesn't exist anymore. It got bought by private equity. I made plus 60% gains with that investment, and all the gains came in one day when the news broke out that private equity will buy it off from stock exchange. So that was a huge win for me, and it seems a little bit winding down with funeral home and cemetery operators. No buys there anymore for me in the stock exchange, so no funeral homes and cemetery businesses anymore in my portfolio. So yeah, like private presents are out of my portfolio when their valuation has gone up. Carriage Services is out of my portfolio. Service Corporation never was even close, because my theory is that because it's such a huge company in such a stable industry, there must be some institutional investors buying it with higher valuations or something, because Service Corporation the valuation never was at the levels at which it was with Carriage Services and Park Lawn when I invested in Carriage Services and Park Lawn. Not sure why, but that's just my guess. We have there Starbucks and Disney. Okay, risk profiles, I understand the businesses, but they are big names in S&P 500 popular stocks, and they are trading too highly. Their valuation goes to the same category with other General Dynamics, Lockheed Martin, Meta, Apple, Disney, Starbucks. I would need to see minus 50% stock market crash to start buying really these companies big time. Overvalued. Nothing more for me to say, just overvalued. Then you have Manchester United. Well, I'm a football fan myself. You have a big moat company in Manchester United, one of the strongest brand in sports. Premier League team, and Premier League is the big money league of the world. Nevertheless, football business is pretty crazy. I have some videos on my channel on those, so interested in Manchester United more deeply, go and watch those. And Harvia, then I have two left. Let's first go with Harvia. That's Finnish sauna making company, and I just don't understand the valuation. I try my best, and I have I guess the stock is now something like 45 euros. It has been higher in the crazy days of Corona pandemic, but those days saw Harvia being huge. Valuation was sky high, but it still is sky high in my opinion. I'm not sure now, a long time when I looked at Harvia last time, but I think my current fair value is something like 15 euros, and it's now 45 euros. So either I am making some big mistake in my valuation with Harvia, or Harvia represents a rare bubble in a really poor Finnish stock market, which Finland has been doing absolutely terribly last years, but Harvia it went as low as below 15 euros something like 1 year ago or something, and now it's back up in 45 euros or something. And I don't know, is this some Finnish investors anchoring bias, or some hyped up stock which just all the time trades, well, not all the time because it dipped really low under 15 euros once, but most of the time just trades way too high valuation. I don't know. Harvia is the worst company out of my watch list, and we see who is wrong. Is it me or is it the market? We will need to come back to this in the future. And if Harvia can a little bit described as the Tesla of Finland probably. So let's move on to Tesla. Higher risk profile comes because, well, I think the man running the company, Elon Musk, is spending lots of his effort and time to weigh other things than Tesla. So you have a CEO whose focus is all over the place. Not a good thing. Elon Musk obviously is a genius as a businessman with creating Tesla, creating SpaceX. I'm not claiming anything else. But when you have a CEO whose focus is so all over the place, I cannot invest in that kind of company. On top of other things he is doing. Well, let's not go into that. Nevertheless, Tesla is one of the Trump trade companies too, on top of course Civic and Geo Group, which obviously saw huge increases in stock price when Trump got re-elected. All those gains in Tesla stock price during last week doesn't base on fundamentals at all. Tesla faces a lots of competition and uncertain future, and it's a high risk play, and the reward is really low. I think I have said that the stock price needs to be below 100 even when I start looking at Tesla more deeply. Now it's, I guess, somewhere over 300 again after the Trump trade. Again, stock price is not based on fundamentals at all, in my opinion. So let's see what happens with Tesla. But I think Harvia and Tesla will never be in my portfolio, probably because, well, for different reasons, but they both seem to be these hyped up stocks still that the market, well, Harvia, as I said, was hated by the market. Tesla too was hated at the worst days, but now it's again loved, and I maybe let other people play these stocks and these companies and stay myself focused on these other ones you have seen here. So this was my risk reward matrix. This is a long video, almost half an hour. I hope you enjoyed this one. Let me know in the comments, what do you think? Which are my biggest hits in the matrix, or am I going terribly wrong with some valuation of some companies? Let me know in the comments. Remember, these are only my valuations, not financial advice ever. You need to do your own valuations every time. You need to build your own conviction in your investments always. Hope you enjoyed this risk reward matrix. I enjoy doing this for you and talking about my positions and companies on my watch list. Thank you for watching this video, and I see you in the next one. Bye bye.